Behavioral finance exists because traditional finance made a dangerous assumption that investors are rational. On paper, this assumption makes models elegant and markets efficient. In real life, it collapses almost immediately. Investors are not robots processing information flawlessly. They are human beings, carrying fear, hope, pride, regret, and social pressure into every decision. Behavioral finance does not try to fix this reality. It tries to explain it, because understanding why investors make mistakes is often more valuable than knowing what the correct decision should have been. At its core, behavioral finance studies how psychological biases systematically distort judgment in financial decisions. These distortions are not random. They follow patterns that repeat across markets' generations and asset classes. This is why bubbles and crashes look different on the surface, but feel eerily similar underneath. The same emotional scripts are replayed with new characters and new technologies. Understanding these scripts does not make you immune to them, but it gives you a chance to recognize them while they are happening, rather than only in hindsight. One of the most fundamental investor mistakes is overconfidence. People consistently overestimate their knowledge, skill, and ability to predict outcomes. In investing, overconfidence leads to excessive trading, concentrated positions, and underestimation of risk. It convinces investors that success is due to skill, while failure is due to bad luck. This asymmetry prevents learning. Markets quietly punish overconfidence by extracting costs through volatility taxes and poor timing, often without dramatic warnings. Closely related is confirmation bias, the tendency to seek information that supports existing beliefs while ignoring contradictory evidence. Once an investor forms a thesis, they naturally gravitate toward news opinions and data that reinforce it. This creates a feedback loop where confidence grows while understanding narrows. Confirmation bias turns investing into advocacy rather than analysis. The danger is not that investors are wrong, but that they become blind to being wrong. Loss aversion is another powerful force. Investors feel the pain of losses far more intensely than the pleasure of equivalent gains. This leads to holding losing positions too long, in the hope of breaking even while selling winners too early to lock in gains. Rationally, gains and losses should be evaluated symmetrically. Emotionally, they never are. Loss aversion distorts portfolios over time, concentrating risk in underperforming assets and reducing exposure to long-term winners. Then there is herd behavior. Humans are social creatures. When uncertainty rises, following the crowd feels safer than standing alone. In markets, this instinct drives investors toward popular assets at precisely the wrong time. Herd behavior explains why valuations detach from fundamentals during booms and why panic selling accelerates during downturns. The comfort of consensus often replaces independent judgment, even when evidence suggests caution. Another subtle but destructive bias is recency bias. Investors overweight recent events and assume they will continue indefinitely. After strong markets, optimism becomes excessive. After declines, pessimism feels permanent. Recency bias shortens time horizons and encourages trend chasing. It causes investors to extrapolate the immediate past into the distant future, ignoring the cyclical nature of markets. Anchoring also plays a major role. Investors fixate on reference points such as purchase price, recent highs, or round numbers. These anchors influence decisions even when they are irrelevant to current value or future prospects. Anchoring makes it difficult to reassess positions objectively. Prices become emotional landmarks rather than signals to be interpreted in context. What makes behavioral mistakes especially dangerous is that they feel reasonable in the moment. They are reinforced by emotion, narrative, and social validation. Rarely do investors think I am acting irrationally. Instead, they believe they are being prudent, informed, or patient. Behavioral finance reveals that many mistakes are not errors of intelligence, but errors of self-awareness. Importantly, behavioral biases do not disappear with experience. Professionals suffer from them as much as novices, often in more subtle forms. Knowledge changes the expression of bias, not its existence. This is why understanding behavioral finance is not a beginner's topic. It is a lifelong discipline for anyone who participates in markets. The real value of behavioral finance lies not in labeling mistakes, but in designing systems that reduce their impact. You cannot remove fear and greed, but you can structure decisions so that fear and greed have less room to operate. Rules, automation, diversification, and predefined processes exist not because investors are weak, but because they are human. As markets become faster, louder, and more socially connected, behavioral pressures intensify rather than fade. Information spreads instantly. Comparison is constant. Emotional contagion is amplified. In this environment, understanding investor mistakes is not optional. It is defensive knowledge protecting capital and judgment from the most persistent adversary you will ever face in investing yourself. And as we go deeper, the real challenge is not recognizing these biases in theory, but learning how they show up in real decisions, how they interact with one another, and how investors can build practical safeguards that reduce their influence without demanding impossible levels of self-control. Because awareness alone does not change behavior, and that is exactly where we need to go next, by examining how these behavioral biases actually play out in real investment decisions, and how they quietly reinforce one another, because mistakes rarely arrive one at a time. Overconfidence feeds confirmation. Bias, confirmation. Bias deepens. Anchoring, strengthens. Loss aversion. And loss aversion pushes investors toward herd behavior at exactly the wrong moment. What looks like a single bad decision is often the final step in a long psychological chain that began much earlier, unnoticed, and unchallenged. Consider a familiar pattern. An investor experiences early success in a rising market. Confidence grows. Trades become larger and more frequent. This overconfidence leads the investor to seek out opinions and data that support existing positions, dismissing warnings as pessimism. When prices begin to stall, anchoring takes hold. The investor fixates on recent highs, framing any decline as temporary. Loss aversion then intervenes, making it emotionally painful to admit error. As prices fall further, the investor looks around and sees others selling. Herd behavior provides emotional permission to exit, usually near the bottom. Each step feels justified in isolation. Together, they form a textbook behavioral collapse. Another common scenario appears during long periods of market calm. Recency bias convinces investors that low volatility is normal and permanent. Risk feels distant. Portfolios drift toward concentration because diversification seems unnecessary. When volatility eventually returns, the emotional shock is severe. Decisions are rushed. Selling happens not because fundamentals changed, but because expectations were never realistic. Behavioral finance teaches that calm markets do not remove risk. They anesthetize awareness of it. Understanding these patterns is uncomfortable because it reveals that intelligence does not guarantee protection. In fact, intelligence can make biases more dangerous by enabling better rationalization. Smart investors are often excellent storytellers. They explain away uncomfortable evidence with sophisticated arguments. This is why behavioral safeguards must operate at the level of structure, not insight. Knowing your biases does not prevent them from acting. Designing systems that limit their influence does. The most effective safeguard is pre-commitment. Decisions made in advance during calm periods carry far more weight than decisions made under stress. Investment policy statements, rebalancing rules, position size limits, and predefined exit criteria all serve this purpose. They reduce the number of decisions that must be made in emotional moments. Less decision-making means less opportunity for bias to interfere. Automation is another powerful tool. Regular contributions, automatic reinvestment, and scheduled reviews turn good intentions into default behavior. Automation does not make investors smarter. It makes them less tempted to intervene. In behavioral finance, reducing temptation is often more effective than increasing discipline. Diversification also plays a psychological role beyond risk reduction. A diversified portfolio reduces the emotional intensity attached to any single position. Lower emotional intensity leads to better behavior. Concentration amplifies not only returns, but fear, regret, and attachment. Investors who underestimate this psychological effect often discover too late that their real risk tolerance was lower than their theoretical one. Limiting information intake is another underappreciated safeguard. Constant exposure to market news, opinions, and social comparison feeds recency bias and herd behavior. Investors who deliberately control when and how they consume information create mental space for long-term thinking. This is not avoidance, it is hygiene. Clear thinking requires quiet. Perhaps the most important behavioral shift is redefining success. Investors who measure success by short-term performance are constantly vulnerable to emotional swings. Those who measure success by adherence to process are more stable. Process-oriented investors accept that some decisions will look wrong for long periods. They understand that consistency, not brilliance, is what allows compounding to work. In the end, behavioral finance delivers a humbling lesson. The greatest risk in investing is not market's instruments or even mistakes. It is the illusion that we are immune to making them. Investors who survive and compound over decades are not those who eliminated bias, but those who built lives and systems around the acceptance that bias will always be present. If this exploration of investor behavior resonated with you, consider subscribing to stay with these long-form conversations, focused on building structure stronger than emotion. And leave a comment sharing which bias you recognize most clearly in your own investing, because self-recognition paired with the right safeguards is where lasting improvement actually begins.